Good morning, everyone. Glad to be with you guys today. The Holy Macro Show. We are back. We're here every Friday at 10 a.m. Eastern Time. I'll try to post that earlier. Something I was thinking about today, Kashop. I was like, I am so late on posting when we are doing this, even though we do it every week and people do know that. I will try to get it on the YouTube channel a little bit sooner, probably like after we get off here. I'll probably try to make it so then it's just up there, then everybody can see it and get on it if they need to. I'm glad somebody brought that up. If you guys have any marketing ideas for me, feel free to always hit me up because I am the worst marketer ever. I'm just a guy who likes to trade, been doing this for a long time, really enjoy it, but I am not much of a marketer. So any of you guys who want to tell me things that would make it easier for you guys to get on here, please let me know. I'm glad we've had so many new people coming on, so many people joining us. It's been awesome. We've got a great show today. If you guys didn't get a chance to see it, definitely check out the interview with Jason Shapiro that I had this week. One of my favorite interviews this year. It's just basically like the ability to have somebody on and just we're not going to have any sort of conversation about some bullshit speculation. Gold to $50,000 or oil to 500 or whatever. Like we talk about why that's yes, you can do that. Yes, tons of people get on TV doing that. Sounds great. But in reality, we don't know exactly where these prices are going most of the time. We just know the probabilities are on our side, and however you trade it, you do it that way. So I thought that was a really cool interview. Jason had a really good time on there. He was really funny, very charismatic, energetic. It was a good time. So definitely check out that interview. You go to my YouTube channel. It is the last live before this one. So Kashop, today we have so much going on in the market that people forgot there's something that's very fundamental to what is going on here. Now, I'm not saying we're headed towards hyperinflation right this second. I am saying that inflation is the primary trend. We have never stopped having inflation. Yes, you could look at it and go, well, at this point in my life, oil prices were going down. And at this point in my life, candy bars were cheap, whatever the hell you want to say. In reality, money always is going into somewhere. So like there's a reason why the stock market has gone up for, God knows how many years. Go back to the early 1900s. Yes, you've had depressions, you have recessions, but it continues to go higher. That's also a monetary concept. As there's more money in the money supply, the higher prices can go and so on. We'll talk about that a little bit more today. But because of this, there's a reason, and it's because of the debt machine. So kind of looking at this today, I made this, and if anybody wants this, feel free to just send me, don't send me an email. I try my best to get to everybody's emails, but it's a mess sometimes. So definitely hit me up on Twitter, hit me up on Substack, hit me up wherever you want. Just send me a message, and I will try to send you this if you guys want it. But looking at the idea of inflation. Because of the amount of debt we have, we will always be in inflation. That's the reason why, Richard Russell used to always say the phrase inflate or die, because the central banks have a choice. It's inflate or die. And, they're not suicidal. They're not planning to kill themselves. That would be a big help for most of humanity, but that's not anything that's going to happen anytime soon for the central banks. So as they kind of continue this direction, they will continue to inflate until the end. And the end is hyperinflation. And so, Kashop, I want to pass it to you because you are really, really in depth on this subject. You know a ton about hyperinflation, inflation, debt, and what's going on. So, as we have crossed $40 trillion of debt, it's getting funnier each year because the numbers just get insane. I remember being a kid. I think we crossed $1 trillion, and it was like a huge news story. Now it's 40 trillion, and it's not even on the cover of anything. Nobody even gives a shit. So, Kashop, what are you thinking here about the debt, hyperinflation, where we're possibly ending up soon? We'll talk about the Fed in a minute, but and what they did recently, but just talk about what you think about the debt, inflation, and where we're headed.
So if you look at what is the actual difference between inflation and hyperinflation, inflation is just government printing too much money, central banks printing too much money. That's the Austrian definition, and that's the real definition. Hyperinflation happens when the public loses confidence in the currency. Now, that can happen because of war-related debt. That can happen, like if the US, because it's a reserve currency, it can happen because everyone decides, hey, let's not transact in dollars because it's too risky. And why would that happen? Well, Trump just came out and said anyone dealing with Iran will face secondary sanctions from us. And if you use the dollar, we are going to use that as a club to beat you. So, what are people who hold dollars, who are trading in dollars, who may or may not have exposure to Iran in a secondary way? What do? Well, they're like, let's just get rid of these dollars, use euros, pounds, even Bitcoin, whatever. And then that's exactly what they are doing. So, and at the same time, the government is running something like $432 billion a month in deficit. That's the July deficit. It's a record level. And even if you say, that's extraordinary, that's not going to last, okay, maybe it gets down to 300 to something closer to 400 billion a month, which is a huge amount of money. And soon, within a year, this 40 is going to go to 44, 45. And then you add in all the unfunded liabilities on top of that, and it's just going to keep exploding. Now, all of this debt, it has to end up on the Fed balance sheet. And that's pretty much what they're already doing. So put all this together. On the supply side, you are expanding the supply of the currency. On the demand side, you're threatening anyone who uses dollars and hold dollars, saying, if you use it, we will sanction you. So you're having high supply increasing at an accelerated rate, and you're bringing down demand in a way that's kind of like a shock because well, no one expected this, right? Like until 5, 6 days ago, no one really expected something like this. So you have a demand shock and supply rise going on at the same time. So it's going to be, it could be hyperinflationary, but it is at least going to be massively inflationary. And I think it crosses the point where it gets hyperinflationary when people realize that, you know what, we don't need dollars anymore. Why can't we use euros? Why can't we use the Chinese RMB? Why can't we use the offshore RMB or any other currency? So the first currency which says, hey, we have a great settlement network, we have a great rule of law. You can use our currency for international trade, settle it in our banking system, our clearing system is going to have a massive, massive advantage. And just imagine if by some stroke of luck or whatever, like gold happens to be that settlement currency. And that's actually a much better, more palatable idea for everyone than using some other fiat, because once you use some other fiat, you're just giving some other government the control. So when we see gold exploding higher, especially this week, you cannot just say, hey, I think it's going parabolic. I think it's, overdone or whatever. You can just see it as it is the start of a new monetary order, and it's because of this 40 trillion, this debt shock, the ample reserves policy, and whatever the government is doing to the dollar, all of it put together, coming around at this exact point of convergence, which is, well, this week.
Yeah, I mean it's interesting, and also the idea between about hyperinflation. It's 50%. Is it? Yeah, the number is 50% inflation rates per month is what technically is hyperinflation. So I'm not saying we're headed towards hyperinflation tomorrow anytime soon. I don't think Kashap is either, but we're probably headed towards something pretty nasty. And who knows, it could get out of control and create hyperinflation. Either way, we're looking at like the environment that we want to trade in. We want to trade like it's a stagflationary environment, whether it's hyperinflation or not. And also, here's the problem: everybody looks at hyperinflation and goes, "Oh, that's silly." There's hyperinflation is so crazy. That's why would we even think about that? However, at the same time, there's a reason why the Fed was like, "Hey, 2% a year." Compounding that together over a very long period of time will give you very high inflation rates. It's the reason why people can look back and be like, "Oh my gosh, since 1971, the price of blank has increased 1,000x." Like you have 2% compounding. Like people know, as traders, you guys should know what compounding is. You have every year you have 2% returns, steady returns, 2%, 2%, 2%. At some point, that becomes a pretty large number. And in a way, it gets out of control if you have any type of variance in it, which we've had plenty of them. The only variance to the underside has been like a couple, years of 1.8%, where the Fed is crying on TV every day when that happens. They're going, "Oh my God, we don't have any inflation. We're messing everything up. We need to lower rates. We need to do this. We need to do that." We don't need inflation to survive, guys. Like we had the whole industrial revolution and we didn't have a ton of inflation. And so like we don't need inflation for growth. We don't need inflation to survive. It's okay to have market crashes. It's okay for the market to never not go up every single day. Like all of these things are okay. But they've kind of been in that scenario because of the amount of debt we have and to pay it off, as Kashap has talked about. So here we are today, $40 trillion in debt. And so, Kashap, you've talked about this one a bunch over time, and we've had a lot of discussions about this, but you are a great history buff. You know a ton about this stuff. And we get to the $100 trillion bill from Zimbabwe. So, can you talk a little bit about this time and this period? Because a lot of people have no idea about these hyperinflationary periods. I wrote recently about Germany, the Weimar Republic. So I talked about that a little bit. I talked a little bit about this the other day, but I'd love to hear your take on it, just because you know even more than I do about the Zimbabwe one. Kashap, we can't hear you. I think you're on mute.
Oh, that. Yeah. Sorry
Gotcha.
about that.
No problem.
Yeah. The hyperinflation actually, it wasn't exactly a strict monetary phenomenon in Zimbabwe. So what happened was a new government came in and they said explicitly that they are going to steal all the land from the white farmers and give it to the local black population. And they did that. Prices exploded because of mismanagement and it was utter chaos. The economy collapsed. Now, what do you do when an economy collapses? One, you can take your medicine, like pretty much what Iceland did, and you can say we are going to clear all of these excesses out so we can grow again. Or you can take the Greek approach or the Zimbabwe approach where you're like, hey, I'm just going to print money and paper over the problems. So that's what they did. And then you ended up with this $100 trillion note. And then, so here's the thing, Zimbabwe is very, very resource rich. So even now, if you want to look for gold, platinum, anything, it's a great jurisdiction to go look for it, find it, maybe not mine it because, all the risk, but it's a great resource nation. So what did they do? They're like, well, this currency is collapsed. Let's back another one with gold. And then they tried that. And then they're like, well, everyone's using dollars anyway, so let's print our own US dollars. And they actually did that. At a point, they started printing their own US dollars for domestic use. And none of that worked because the core problem was never addressed, which is the productivity drop from all the land reforms that they did. So eventually it just ended up as a failed country, and it is still a failed country, even though they are very, very rich in resources. And I hear it's like wonderful to visit, especially the falls and all those areas. It's like a great place for tourism, great place for resources, but the country is in shambles. And all because they did this one reform which led to another and which led to another. And if you actually read Mises, so Mises has this book on interventionism. So Ludwig von Mises, he's kind of the we call him the father of the Austrian economics movement, even though there were others before him. So he wrote this book called Interventionism, where one intervention inevitably causes some problems downstream, which leads to another intervention, and then on and on and on. And that is exactly what Zimbabwe went through, and it is still going through. So it's a fascinating case study of what happens when you try to fix one problem with a bureaucratic solution, which ends up creating another problem.
Yes, I mean that's the big thing. And we had a question here. What are the potential consequences of deflation in China? I thought this was kind of interesting because one is deflation exactly. I'm not sure if I call it that, but Kashap, you know a lot about China. Kashap writes a lot about China, what's going on with China, has a real good pulse for what's going on there. So what do you think about this question?
So if you look at what's happening to the Chinese currency, so there are actually two Chinese currencies. One is the mainland CNY and the other which trades in Hong Kong, which is your CNH. So it's kind of like the offshore yuan. So if you look at typically the People's Bank of China, which is like that Federal Reserve, what they do is they control the mainland rate, and they have a. I mean, the currency is being pegged for something like 30 years now. So what they do is they have a 2% band plus or minus. That's where they allow the currency to move. And then if you look at the free market rate, which is the Hong Kong rate, it usually trades at either a premium or a discount to the mainland rate. And right now, what is happening is it's trading at a premium, which means that the offshore yuan is stronger than the mainland yuan, and that's because there's a tremendous amount of demand for the Chinese currency. And this is sort of unusual because you would think a country which has capital controls, people would want to move their money out. Like if you look at India, I think the latest rate is something like 95.7 to the dollar. But if you look at USDT, which is the most liquid form of money that you can move outside the country, that's trading at 101, 102. And India, in fact, actually had to kill the whole crypto market just to stop this capital flight. So you see Tethers trading at a premium to dollars because, well, you cannot really access dollars as a resident Indian. And then you go to China and you see that the offshore yuan is trading at a premium, meaning that there is so much demand for the currency that they are bidding it up, which it's highly unusual. And if the interesting thing is like we don't have the chart here, but I put up the chart yesterday on Twitter. The currency has appreciated in a straight line. It's like an almost 45-degree line uh, for I think like 7-8% within a year. Now that is again highly unusual. You would think that every other mercantilist nation, or that's the economic policy that they call it, like you have to weaken your currency in order to strengthen exports. And the Thai baht has bucked that trend, the Chinese yuan has bucked that trend, and even the Swiss franc, if you look at it, it's appreciating. And even the Colombian peso, it's pretty much gone the same 45-degree line. It's like appreciating massively versus the dollar. So all these are just telling you that well, the dollar is the one that's inflationary. So, which means that by corollary, all the other currencies are getting deflationary. And potential consequences, well, it's great for living standards, right? Japan had deflation for 30 years, no problem. And now they have the reverse problem and everyone's going bankrupt. So deflation is actually a good thing to have. And I think China's realized it. I think the so-called mercantilist economies, they have realized it. And only the US hasn't realized it. And they're like, hey, we are going to say 2%, but we are actually going to run policies that give you 5%. And then, there'll be some uh, manipulation of the oil price, and we'll just tell you that, hey, look, coffee has gone down, or like you said, candy prices have gone down, and then people believe it and think there's no inflation. It's like just ridiculous. But you really want to see deflation in China, you really want to see deflation everywhere in the world, because inflation is the real killer.
Yes, and that's the thing that I don't think most people understand, because it's like going back to the first one, it's like, yeah, who loses, like in inflationary times. Now, once again, this is the reason why we invest. This is the reason why we trade. You go all the way back to that book by The Battle for Investment Survival. That book, what was that, written in the 20s? It's written so many years ago, GM Loeb. And so, basically you go all the way back to that book, and they talk about the main idea of investing is to outpace inflation. And you'll hear that from Austrian economics books. You'll hear that from old trading books. Whatever it is, you want to outperform inflation. And the reason why is that, look at who wins. On the who wins column, it's the government wins, the borrowers win, asset owners win, owners of real things. Like these are the people who win. Who loses? Most of the people you guys know, most of your friends, most of your family. Because hey, even the person who's going, hey, I do make good money, but I'm afraid to put it in the market, or I'm afraid to put it into gold, or I'm afraid to do this with it, so I'm going to just keep it in cash and keep it in my account. Same thing if you're looking at, fixed income earners is also on there. Some people would say, oh my gosh, well, this stays with inflation. That is horseshit. That is totally unbelievable, that people even still think that. But you're basically looking at cash with the yield. If inflation is running, and once again, not look at the CPI numbers if you want. Send me another true inflation thing if you want to. All of that's bullshit. If you look at real inflation, what's going on, if you're making, a your risk-free rate as your bonds are getting kicked in the nuts of 5%, as your bonds are losing 5%, and you're basically might as well invest in cash anyways, or losing more than cash, you're losing money either way you look at it. Like, so once again, you want to own real things. You want to own gold. You want to own real estate. You want to own real assets. Even the stock market is going to do better in inflationary times than just being in cash or being in bonds. So anything will do just about better than sitting in cash currently. So make sure you guys are paying attention to that one thing, because this is the whole reason why I invest the way I do, is because I get an understanding of like, hey, if we have real inflationary cycle and I can be in these, like 2022, if I can be in energy stocks and they're up 50, I think it was 52% that year in 2022. If they're up that much in 2022 and, the market's down, bonds are getting killed, but my home costs are going higher, heating costs are going higher, food costs are going higher, I can still make money and be, settled and take care of my family and whatever else I need to, by understanding, hey, the cycle is inflationary. I need to be here right now. And so that brings us to what happened this week, Kashop, which is just fantastic. So the Fed came in. I thought this was awesome. They came in and they were like, we're buying up bonds. We're going to buy up the long end. And everybody got very excited. I bought pulled onto a show. They're like, yeah, well, now is the time to trade bonds to the long side. I'm like, yeah, whatever. You want to give that a shot, go ahead. But I've seen how this works every single time. It's just a bunch of people get very excited, and they ran this on it. Like, look at the bond yields diving from 5.28 all the way to 5.18. I mean, 10 basis. I mean, oh my God, 10 basis points is the best thing ever. I mean, literally, like, this was hilarious, because if you looked at the 10-year didn't even care. The 10-year was like completely flat on the day. Short-term yields actually were like, this is stupid, and went the other direction, which is part of the thing they wanted. But at the same time, it's like, then the next day, TLT, or 30-year bond, however you look at it, was down once again quite a bit, almost 1% yesterday. I don't know if it's down today or not, but to me, this isn't a scenario that ends up in, hey, bonds now are going to be a great investment, you want to own bonds. This ends up in a scenario where more liquidity just came into the system. And right now, it's going to take time to trickle into everything it is, but it gets people excited. The second liquidity's in there, everybody's excited, everybody's buying things. And as that continues to trickle in, we're going to see more upside in a lot of risk assets. And especially the commodities market. At this point, when you're in an inflationary cycle, the commodities market is going to outperform. Look at cotton having a huge move this year. You look at, wheat, soybean oil, corn starting to move, actually. Like, all of these things are starting to make big moves. And not to mention gold, not to mention silver. I mean, I could just literally say everything. Energy's hitting an all-time high. Everything in the commodities complex is ripping higher right now. While everybody's going, well, inflation has been solved because they dumped more liquidity in the market. Kashop, what did you pick up from this week? This was a funny one to me, because I was just like, man, I can't wait for Friday for me and you to talk about this.
Yeah. So one commodity you left out is sugar, and
Yep.
everyone in India is kind of talking about it, because so India has gone from being a sugar exporting nation to a sugar importing nation now, and prices have hit a 10-year high. It's wild. So yeah, I mean, like, I know we talk about it a lot, but it's just crazy the way we see commodities moving, and then people are talking about a super El Nino. But I know you asked about the treasury, so let's get to that. So the Treasury Secretary, all he said was, we are going to at least double the buyback for each operation from $2 billion to $4 billion. Now, if you look at the amount of debt that's outstanding, that's almost 40 trillion. Let's say roughly 30% of that is on the long end, loose numbers. And you see that the deficit is, as I said, for July, it was $432 billion. Turning one buyback from $2 to $4 billion, does it even make a difference? Absolutely not. It's just absolute nonsense. And the market ate it up like, oh, look, some great intervention is coming. Like, no, it was all just done to fool the algos and maybe, buy a little bit of time. It's like the constant yen interventions that they do. All it does is take it below 160 and then it's back above 160 and then they have to intervene again. So this is pretty much all they are doing. It's just job owning with a little bit of action, thinking that like the way you scare a bear or something, like you just look big and then it gets scared. And no, the markets don't work that way. The once the market sees your bluff, it's just going to go back to whatever was the trend earlier. And that is exactly what we are seeing with yields today. So there was this brief pop where yields dropped, and then it's back to business as usual once everyone figures this out. And it's going to be the same thing over and over again, because it's like Wash coming out and saying that 2% is a real target. And what are you doing about it? Well, nothing. We have a family fight about it, and then we end
Yeah.
up doing nothing. And yeah, you can get away with that maybe once or twice, but then markets move fast now, and capital moves really, really quickly, as you have seen with the Silicon Valley Bank disaster, where all it took was one day for all the depositors to leave and the bank to fail. So when moves happen so fast and all you're doing is job owning, the day the market realizes, okay, there is really not going to be any action on this front, is just going to be explosive move in yields, explosive move lower in bonds, and I don't think anyone's prepared for it. And I think that's really where we are going to get the blow-ups, like we saw with LTCM, where they had all this leverage on their bond trade. And I'm pretty sure there are a lot of hedge funds who have been playing this trade who are going to get taken out once that move happens. And it's a matter of when, not if, especially if the Fed doesn't print the money to buy back the bonds.
Yeah, and it's just like going to be I mean, this is the thing about it that's just funny, because it's like it's just liquidity. Like, think of it, trading is as simple as you make it sometimes. I will be the first to say I know a lot of stuff. I read a lot of stuff. I am very simple though. Trading is very simple for me. I think of things in terms of, especially macro, I think of things in terms of liquidity. What is the bond market doing? Why do I always look at it so much? Why am I always bringing it up? Why do I bring a chart of the dollar and bonds every single week for you guys, or the yield curve? Most people would go, what does that pertain to? I'm buying, Apple stock. Why does that pertain to that? Well, to me, it means everything to that, because we're looking at liquidity. And then when, somebody dumps in more liquidity, I mean, think about it this way. I didn't bring a chart of the 30-year yield and the Fed rate today, but you guys have seen it a million times. Basically, what ends up happening is, as the Fed is lowering rates, the 30-year starts to go higher, which means the 30-year is calling bullshit on the Fed lowering rates and saying that there's more inflation probably coming soon. So as we see more inflation kind of coming down the pipe, that's telling us something. So commodities started to move higher at that point. Gold and silver got out of control. Copper started to move. And then this year we finally got energy moving. So the bond market was completely right about everything. It's the same thing now. What happens when they start to put money into buying bonds? Is that going to change the whole trade? Is that going to, change the direction of the trend? No, because let's think of it simply. It's liquidity. It's nothing but liquidity. So if it's just liquidity coming into the system, yes, you could see some excited people start to buy bonds because they don't really understand what's happening. But to me, I just think, I mean, here's another thing, Kashab. I don't know if you saw this. BlackRock sold their long dated bonds at the same exact time that they came out and did this announcement. So the same exact day, August 19th, BlackRock came out and said, we're out of our long dated bonds and we're buying the short dated bonds. So they did the opposite of what the Treasury did. So I think a lot of them are seeing exactly what we've been seeing. We've been talking about this for a couple years now. I think they're just seeing what we've been seeing, which is, hey, they continue to boost the money supply whatever way possible. That spread continues to widen, which will incentivize banks to boost it when giving us more liquidity. And then they're going to come in here and start buying, which means dumping more money into the system. They're just there's gasoline. They're just dumping it on everything. And then it's just waiting for that match. And that match is coming. And it's already coming to certain areas, but it's going to continue to come down the pipe. I mean, here's TLT. Everybody told me this was, this is the time. It's getting over these major levels, Kashab. We can't possibly go any lower here. The Treasury, and then people were like, "Don't." People said this to me. This is what cracked me up. This has been a thing that's happened probably 5 times this week. Jason, aren't you fighting the Fed? And that shit is cracking me up because it's like, guys, understand, like, one, the Fed says shit and then the Fed does shit. There's two different things. If the Fed is saying we're going to do blank and we're going to do this, but they're holding rates low, like Ashop talked about, 2%, we want to get back to 2%. They're holding rates low. That means they don't give a shit. If they're coming in and saying, hey, we want to bring down inflation, but we're going to come in and buy the bond market because we need to start supporting that, that's just creating more liquidity. So, like, they're just continue to do the opposite of what they're saying they're doing, and everybody's eating it up. That's the thing that's funny to me. But TLT, this breakdown, I don't think that's going anywhere. I think it's going to head lower. The only thing that, like, what would invalidate, people always ask, what would invalidate this? We really start to make new 52-week highs. We get above the 90, 91. Sure. I'd fucking be floored though to see it, to be blunt about it. I'd be floored to see that in the current environment that we're in. So Kashab, you want to talk about the dollar a bit today. I do too. The dollar being in this uptrend all the way going back to basically 2008, but we could say on this chart 2012, 2011. We see this massive uptrend moving, but now we had that false breakout. We just turned over and started rolling down pretty quickly. So what are you thinking about the dollar going forward here? I think my own opinion is we're headed to 90, 92. Like, I think that's going to happen pretty quickly. Once we get below these major levels, we start to see below 96. I think we're headed to 92, 90 pretty quickly. So what do you think about the dollar? We've talked a lot about how to save money, how to do this, but what do you think the dollar is? What do you think about the dollar pertaining to the stock market, pertaining to gold, pertaining to oil, or any of these other inflationary assets that we've been buying recently?
So when you had the Treasury announcement saying they're going to double the buybacks, the biggest move was in the dollar. It went straight down, and then it kind of recovered the next day, and then it went straight down again. And that is really telling you something. And it's the same thing that when the US said they are going to save the Japanese yen. And so what did they do? They sold their euros to buy the yen. And it temporarily worked in bringing the yen from 162 to 158, 157, whatever. But the moment they said they are selling euros, the euro started to strengthen versus the dollar. Now, that's the kind of move that you do not expect to see unless the market is challenging the government or challenging the central bank. And that's exactly what we are seeing. And that is the same move that we are seeing in the dollar. And it's the same move we are seeing in treasuries. And it's the same move that we are seeing with the AI bubble stocks as well. So now almost everyone in the world is talking about, especially after seeing the South Korean stock market bubble collapse, they are all talking about how the AI bubble is going to collapse and it's going to be a systemic risk. Like, I think the biggest sovereign wealth fund in Norway came and said that if the AI bubble collapsed, their fund would effectively go to zero or they would lose 90%. And it was a crazy statement to make. But that tells you how much the world is invested in the US stock bubble. And it tells you, again, like looking at how the dollar's moving, how yields are moving, it tells you how much what they're actually doing to get out of that. Meaning they're selling dollars, they're selling bonds, they are sort of selling stocks, but not exactly. And the reason for that is, well, the market has been so strong, so everyone's sort of complacent. But once that changes, it's going to change fast. And it's all the same trade. The trade is to get out of US assets. It's to get out of US dollars. It's to get out of US bonds. It's to get out of overvalued US stocks and into something else. Now, what is that something else? And that's the fascinating part. I think the market is still trying to figure out what that something is because we are getting crazy moves in everything. Like, look at the gold miners, for example. They are just going vertical. Look at Bitcoin, just went vertical. And why are all these assets moving this way? Well, it's just the liquidity coming out of the US bubble, the dollar, the bonds, and the stocks. It has to go somewhere. And where is it going? Right now, it's just going everywhere. And maybe in a couple of months, it's going to consolidate into a few strong trends. But whichever way that it is going, the one thing that's very clear is the dollar is done and US bonds are done. US stocks, it still remains to be seen whether they are done or not, but I would lean once you have two out of three confirming your macro thesis, I would say the third one will confirm as well. And we are going to see that move. It's just like when gold and silver start to move, you see platinum and palladium move, you see rhodium move. Why? Well, there's a correlation. You cannot really explain it, but when people see that move, that's how they react. And it's the same way. Once investors start to see the dollar go down, once they start to see US bonds go down, they're going to be like, hey, US stocks are next, and we have to take down exposure. So I think that's what's going to happen. And I think that's a world almost no one is prepared for, including people who are outside the US, because we are just so used to following US market news, US politics, US central banks, the Fed, what everyone's doing, especially what Trump is doing. Like he's got the world's attention. So we are not used to a world where none of this work. What do you invest in next? And I think that's going to be amazing for us as commodity investors, because commodities don't really care about all this news. Like, what is coffee going to do? Well, if there's a heat wave, what happens to the Robusta crop? So that's really all that matters. Doesn't matter whether Wash is saying, we care about 2% or whatever. So we just need to watch the fundamentals. We need to watch I mean, if you're trading the softs, then you're watching the weather. I'm not, but you're watching all the other fundamentals, and we are taking moves accordingly.
Yeah, no, totally agree. And so speaking of the dollar getting weak, I'm not sure if for me the stock market, and this is the reason why it's important to watch liquidity, because if we're looking at the stock market, how can I stay long semiconductors all this time? For me, it's just a simple, they continue to, like, the reason when they're putting the thing a lot of people gloss over when we're talking Kashap is the fact of what is going on. Like, what is the liquidity really doing? Liquidity covers up a lot of shit. Same with inflation, covers up a lot of shit. So if you're looking at like liquidity and inflation, you're seeing both of these indicators moving higher. So liquidity is moving higher, inflation rates are there because of liquidity and so on. Like, we're going to cover up basically all of the real bad shit that's going on in the market. It's kind of like the Buffett quote, when I forgot how it even goes at this moment, but do you remember this one when you catch everybody?
The tide is going out, you realize who is swimming naked.
There you go.
Yeah.
So off the top of my head right now, I couldn't remember it for some reason, but that's the one thing to think about. So it's like when you look at inflation, and that's the tide coming in, and you have liquidity, that's the tide coming in, and then the tide going out is when we have liquidity conditionings tightening. And so when that happens, that's probably the end of all of it. But as long as they continue to come in here and rescue the market every chance they get, who knows? But the biggest thing is, where's the outperformance? And the outperformance might not be in the things that you guys have been in for years, might not be in Apple, probably won't be in Microsoft, probably won't be in these names. Where the outperformance is, especially right here, right now, look at this list. Over the last month, you're looking at gold miners, some energy, gold miners. Like, this is where the outperformance is currently. And this is a thing we talk about a lot. And, even just a few weeks ago, and we'll talk about that a little bit more, Kashap, soon. But, we were talking and you were like, this is a great time to start buying gold miners. You were saying it for the last 3-4 weeks now. And then I started to get signals and I started to get long these things as well. And then this explosion happened where right now, month to date, we are up 35% in GDX. 35% month to date. It's 15 trading days into August, guys. Yes, gold has good seasonality in August, but at the same time, this is an insane move that's happening. And so here's a list of them that we're kind of looking at right now. ETH is making its way up there. We'll talk about that a little bit more later. But gold and silver, and to me, this is something that I brought up a bunch of times, which people think I'm insane when I bring this up, but I'll bring it up again and again, which is the fact that silver most of the time starts to, every cycle has this peak. It's a very quick peak, but it outperforms gold completely at some point. We haven't seen it yet. Yes, it's made some big moves. Yes, it's outperformed gold over certain time frames, but actually taking it up, getting up to that 4,000, 5,000% range, gold going back to 1971 will be something that I think could be significant to keep paying attention to. I really like the precious metals right now. I think it's a great place to be. I was out for a while, and you let that thing calm down. We talk about it before. Let it chill out, let it calm down, and then it moves back up, and then you get involved again. We've been involved for a couple weeks. It's looked good. Kashop's been involved even longer than that. We'll talk about that in a little bit. But Kashop, before we get to that, I also want to talk about copper miners. We're seeing some of these copper miners are all starting to break out. I know you're not the biggest fan of FCX. I'm bringing it anyways because hey, it is a big bellwether. It's making a new high. It's one of the big holdings in most of the ETFs. So what do you think about? You don't have to talk about FCX specifically. What do you think about the copper trade currently? Do you think copper base metals fit in with the whole thesis of inflation, or do you think they've already had their run?
So copper moved. If you look at the past cycles, like no one thought it's going to go above $2, and then it did, and now here we are at 6.7. Now, can it go to 20? Realistically, yes, it can. And here's the reason for that. So you brought up FCX, and I actually used to own FCX until they had a big mine disaster, and then that's when I sold it. And the thing with the mine disaster is that it takes production offline. So you have a little bit of cut in supply, and then demand is going up because of the AI trade, new data centers, and whatnot. So you have supply going down, demand going up. It's a very obvious econ 101. So the price is going higher. And now, on top of this FCX news, you saw Ivanhoe had to cut production, and now Codelco, which is the Chilean copper miner, they had to cut production. So on and on, it's like every bit of news item that you're getting is, hey, we are cutting production. Now you're cutting production and demand is increasing. It's just a straight up trade. Now, what could derail it? The only thing that could derail it is, the end of the AI bubble. And I'm not just talking about stocks. All these data center projects, just scrap them all and turn them into baseball stadiums or whatever. So once that is done, then maybe yes, demand for copper goes down. But realistically, that's not what happened. So even when we had the TMT bubble, the dot com bubble, uh, all the cables that got laid out, they didn't get ripped up just because the companies went bankrupt. They gave us cheap internet, which led to the rise of e-commerce and other things. So I think that's what's going to end up happening, which means that whatever demand for copper there is, it's not really going to be hurt too much by the end of the AI bubble. It's just going to be losses all around for the equity holders, but then copper just keeps going higher. And copper also is going to keep going higher because of electrification due to other things. It's not just like in the US, at least, yes, the big story is data centers, but globally, it's about population just consuming more electricity. And that's just a trend that's going to continue for a long, long time. And every way you look at it, there is just not enough supply of copper. Takes 18 to 20 years to permit a new mine. It's crazy, and it's definitely not happening. So it's just long term very, very bullish for the metal. And I'm saying 5 years from now, if you ask me my view on copper, I would probably be telling you it's bullish as well. And 10 years from now, I would say it's bullish as well. So it's not just, hey, this is the trade, like you said, gold miners are up this month. Let's take this trade, let's ride the momentum and then get out. No, this is a fundamental trend. This is a trend that you can ride for a really long time.
No, I completely agree. I mean, you also got Hudbay also looking pretty good. I mean, these are monthly candles. I mean, these are big candles, so the big moves are happening. So Kashop, before we go, I wanted to bring you to this. You've been talking a lot about, and Kashop has been, one of the best mining analysts I've known for many years. He understands what's going on with the mines, mining projects, the different countries and jurisdictions that they're in. So Kashop, what do we got here?
So you talked about me saying that I'm going to get back into gold, and I actually did find the exact video. It was August 1st. So around the 24-minute mark is when we start talking about gold, and that was actually the video in which I said that this is the time to be aggressively long gold, and that turned out to be the perfect call. And Unfortunately, I did not follow my own advice and get completely loaded up. I did get aggressive, but not very aggressive. So I'm sitting on some gains, but it's always like once the move happens, you feel you don't own enough. And once you have a loss, you are like, oh man, I invested too much in this. So it's kind of uh, threading that needle. And I feel I did not get that perfect balance. But for viewers of our show, you should go back to the August 1st episode that was just a couple of weeks ago, and you should look into what we talked about then. And I think the specific calls aren't actionable, but it's a thesis building, and that's really what you get out of this show. And that's really actually a part of my process as well, because when you talk these ideas out, you kind of help frame it in your own mind, and then you go act on it. So that's why I wanted to bring this up.
No, I love it because I think it's important because a lot of people see macro and they're like, they either love it or they hate it. And really, like, to me, it goes back to one of the first really important lessons I learned in a book, Reminiscences from a Stock Operator. In a bull market, all stocks go up. In a bear market, all stocks go down. And he didn't mean like, and he even paraphrases, yes, there's a few stocks that you can get to the upside in a bear market, and there's a few stocks you can get to the downside in a bull market, sure. However, at the same time, that big force is telling you the primary trend of most of the things in the stock market. And so you don't want to fight that. And so that kind of was my first lesson of understanding macro. And then once you start to understand that, then you start to go, okay, because that's a very simple idea. Most people, we can pull up a chart of the S&P and be like, it's in a primary uptrend, very simple idea. And then we get into the other parts of it, what's going on in these global economies, what's going on with commodities, what's going on with these different asset classes like crypto, and then how do we look at risk on, risk off? How do we look at liquidity? All of these things. This all builds a thesis into where the hell we should be to outperform. Because without that, the guys who are on there who are like, I'm a tech investor, I'm a growth investor, I'm a value investor. Like, you're getting stuck into one thing or another. None of that really matters in a bull, or if it's a bear market and you're a growth investor, you're not going to make any money buying growth. But you could be a macro investor and it could be a bear market and you could find a ton of things to buy. You could find a ton of things to sell. You don't care either way because that's what you do as a macro trader. That's why I think macro is probably the most important input for all traders to understand that most people don't give a shit about, honestly. But it is the thing to really do. And that's what I think we do well here every week, is kind of understanding what's going on with the macro. So coming to this one, Kishab, this is Bitcoin. So get into Bitcoin and looking at what's going on with that. One, Bitcoin is great at sniffing out liquidity, which it sure as hell did. So what are you thinking here with Bitcoin? I know you've been back and forth on Bitcoin a little bit, and it's been choppy, and it's been giving me false signals. I've been back and forth as well. So what do you think about Bitcoin?
So this is a clear channel breakout, and what we are seeing is the trend is starting to reverse. So the downtrend that's been in place since last October, that's starting to reverse, and the reversal especially is explosive. So I brought up the CCI, and I think you are probably more qualified than me to talk about the CCI. So uh, what I'm seeing here is just stunning. Like, and I've been in Bitcoin for a long time, and I've known it when it was chopping around at $6,000, $8,000, and we used to get candles like this, and that was perfectly normal. But then once you got all these institutional players in, once you started, the Bitcoin treasury companies, MSTR on, IBIT and all this nonsense, it's just kind of lost that volatility, and now it's like a straight explosive run. And it's not just Bitcoin, it's Ethereum, it's Solana, it's pretty much everything in the crypto space is following this. And there is actually no fundamental catalyst. Like, yeah, okay, you can say Trump is saying this, Trump is saying that. That's like saying, Treasury is going to do buybacks, so, you should buy long bonds. Like, no, that's not how markets work. Like, yes, there is some kind of news, there's some kind of sentiment trigger, but there is no exact fundamentals for this move. So I'm scratching my head wondering what exactly is happening. So the last time we got like these 4, 5 straight updates in Bitcoin, I think it was November 2024, and we found out in January that it was because MicroStrategy did a big purchase, and they timed their purchase to, sort of exactly hit the quarterly top of the Bitcoin price. But what it did was a lot of people front ran that trade, and that's where you got those massive candles. And we don't have that news yet. And maybe it's something similar, though now that MicroStrategy reports weekly, maybe it's not that. So I'm sitting here wondering what exactly is happening. Now, if we had a fundamental news and then we saw this kind of price action, great. You kind of know why it's happening. But now we are sitting here, we are seeing this happening without knowing the why. And that just actually makes me a little more bullish, because if you know the why, then you kind of start thinking, oh, maybe this is overdone, maybe this is over, maybe it's time to fade it. But once you see a move like this without understanding why, it probably means something big is coming, and that is my interpretation. So what do you think, Jason, especially looking at this explosive CCI indicator? What do you see?
Yeah, for me, one, we're over that 75 level, which I think is important. Two is I just see Bitcoin sniffing out that liquidity, and I think exactly what you said is very important, which is, one of my favorite things to trade is when you have a big move and it's breaking a level where there's no reason for it. There's no news, there's no anything. That usually tells me the trend is more sustainable. Everybody's hopping on it, the Bitcoin people, like that's the thing that's hard about crypto is like you always have the Bitcoin bros. There's always the guys who want to pump Bitcoin every single day and say it's the best thing in the world and you can never stop buying it and just buy it on the way down or buy it on the way up, whatever the hell. They always want to buy it. So they're always there. So you can't take their sentiment as a good reading. But what I do see is that a lot of people have kind of moved on. A lot of people, who were crypto people are now AI people. And as they've moved on and they've moved out of the space and there's less and less buying, you're also seeing a move like this, which is significant. Then also at the same time, the smart money, which is out there. So the smart money, so if you're looking at the COT reports, commercials are technically what we call smart money. They've been spectacularly wrong with Bitcoin most of the time. And they're spectacularly wrong right now, which is the opposite of the normal relationship between smart money and dumb money. But Bitcoin it's who exactly knows who exactly the smart money is in this, who exactly knows who exactly the dumb money is in this. But at the same time, I do think that this is, because of all of these things, this is a sustainable trend. And I think we're seeing some short covering too, and all of these things. I don't know what exactly has happened, but I do know the price action is set up to say a trend is starting. Some people would look at the CCI and be like, oh, well, it's overbought. Fucking hate that term. I think it's ridiculous because every good trade is going to be overbought most of the time. Sometimes your entries are going to be overbought. That's just going to happen most of the time. And also, that's not a bad thing. That's a good thing. That's showing you that strength's behind your move. Instead of doing what everybody else does and buying things at the bottom, you see a little bit of strength there. So I think, like Kashop's talking about, I think this thing is just kind of getting started. Don't know the reasons behind it. Don't need to know. I just know that, hey, it's not a bad time to participate in the crypto market currently. But all right, guys, I got to get out of here. Thank you guys for joining us. I did see somebody the other day. I watched their live Kashop, and they were like, you guys should subscribe so I get better data. Everybody has some bullshit thing to say. If you guys enjoy this, please subscribe. Share it with people. Share it with people who need it. If you guys don't enjoy it, don't subscribe. It's as simple as that. We enjoy what we do here. We'll be here every week either way. And we appreciate you guys being in the chat. And definitely come over to YouTube off of Twitter. We definitely love to see you on YouTube because you guys can converse with us, ask us questions. Great to see you guys. Jay, Nick, my brother, good to see you. Free Lee, got Builder in the house. Jay Hampton, all you guys. Thank you guys so much for coming on here and hanging out today. And we'll see you guys next week on Friday. And if you guys don't subscribe to Against All Odds Research, there's a link in the description. You guys can definitely check that out and then subscribe, and then you won't miss any updates. We'll see you guys later.
Bye, everyone.